Hi there, everyone, and welcome to 2023, right? So it's been a little while since I've done a recording, but let's get into it. So a lot happening, a lot to catch you up on, and let's have a look at what we're expecting here for 2023. Now, don't forget that any advice contained within this presentation is general only, so it is tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so let's kick it off with the XJO. You can see, well, basically, where I'll start sort of saying is we missed out on a bit of a Chrissy rally this year, but we're kind of making up for it a little bit here. All right, so we pulled back into the Christmas period and then pushed up throughout the first 5 days of the new year. Now, you know what they say about, a bullish start to the year, guys. It usually leads to a bullish end to the year. S&P 500 in general, if the first 5 days are bullish, should end the year at least 14% higher. Given the big sell down we saw last year, I think that could easily happen. But let's talk about that a bit more when we get on the S&P chart. But for now, guys, let's having a look at this. All right, how did things go last year? All right, through the last half of the year, the last quarter, we pushed right up off those lows, didn't we? Right, 64.50, finished off and topped out at 73.76. Pulled back into Christmas and now looking for a potential break higher here. So really, Monday we did see a break higher. The buying didn't really sustain. So a bit of uncertainty we can see here right at that resistance level at 72, right? So what we're looking for is a little bit more evidence of this breakout actually being sustained. Now, we've got a few big announcements this week that could be holding the market back, and depending on those announcements will probably depend on where we move next, right? But what I think is likely here, okay, is probably a small pullback, higher trough, and then we might have another go at breaking higher. So, there's a few patterns we can talk about here. There's a head and shoulders pattern. You got the head, shoulder, shoulder. If that breaks through 72, then that's looking pretty, said that around a long way. If it breaks 69.50, it's looking pretty bearish, right? The other pattern's a flag pattern, and if that breaks, which it has, okay, if that continues, all right, we could be heading up towards the all-time high at 76 is what that's suggesting. So this could go either way, right? Technicals at the moment are leaning towards bullish, but with a bit of lack of conviction there, still low volumes in markets as well. So the jury's still out in my mind. But you do have some conflicting patterns starting to play out. The current pattern is a bullish flag pattern suggesting 76. Lack of conviction though. The other pattern is a potential head and shoulders, which still hasn't fully shown whether that's going to play out yet either. So I kind of still feel like we're a little bit in limbo here, sitting around that sort of 72. And it's common for our market to whip around the 200-day average as it makes up its mind as well, right? So that's very probable here at the moment too. Now, looking at the S&P 500, it's a very different chart, right? So we can see we've completely disconnected from the S&P at this point of time. So over there, the downtrend's still in play, right? That downtrend is clear, still below the 200-day moving average. Pretty much came to test that last night and pulled off, okay? There wasn't enough momentum to send it through. Well, not surprised, okay? You have got Jay Powell talking tonight. You've also got the CPI Friday morning. So there's, quite a bit happening there that could either fuel this move higher or dampen it off and pull us right back, okay? So depending on how that news flows. I'll talk to you about that view in a little bit more in a moment. But yeah, a very different market, right? So pulled back heavily in December, grinded very sideways through the Christmas period. We had a little bit of a pop up on Friday, tried to continue that pop up on Friday last night, but failed. The move up on Friday, combination of low CPI out of Europe, also pretty damn good job numbers, right? Like it couldn't get much better for markets than that, right? So we had strong job numbers out of the US, but we saw wage growth, well, not declining, but the increase in wages soften off a little bit. Okay, which really is really from an inflation point of view, and that's what the market's heavily focused on right now is inflation and interest rates. That was a pretty big positive, right? That's exactly what the Fed could possibly, want, or what they should be wishing for is, the economy going into a soft landing, which is a robust, strong employment situation, but you see that inflation coming off a little bit as demand pulls off a little bit, and obviously the supply chain starting to restore a little bit as well. So a few things at play there, obviously, that we're looking out for this year. Okay. Technically, guys, if this breakout, so we had a little bit of a breakout, right? There's some resistance still where I've got the yellow line, but we broke out of that consolidation to the upside. And we're just wondering here where this is going to be a false breakout, and we're just going to head straight back lower, okay? Because really the bigger pattern's the pennant, right? That's the big one. And I think we could just whip around here for a little while until we see the proper break of the pennant. So similar thing with the XJ, right? In the very short term here, it kind of feels like it could go either way, right? And we just see this whippy behavior continue. Now, coming across the Nasdaq chart, okay, which is heavily growth-related stock. So the S&P is a good mix of value and growth. The Nasdaq's mainly growth stocks, just sort of techie communication services type plays, discretionary type plays. You can see big pullback, guys. Big pullback through the year. We've come in, we've created probably 4 touch points across this support level. We're now playing around with that support level and tried to drive up off that support level last night. Once again, failed. And you can see here the downtrend line coming through. Okay, and I'll just recolor that. All right, so pennant pattern as well. Now, where sort of this space breaks for me is key. All right, so 1 or 2 scenarios could play out over the next sort of 2 to 3 weeks, right? Because you've got US reporting kicking off this week, but you've also got CPI and you've also got J Powell talking. Not long after all of that, in 2 weeks' time, we're going to have the Fed announcing, and at this stage, you're expecting a 0.25% rate hike. So there's 1 or 2 ways this is going to play out in my mind, right? Scenario 1, we see an ease off in CPI, a slightly less hawkish Fed, and with the recent data we've seen has been, yes, the US economy is slowing down, but we're still seeing a robust employment situation. To me, that leads to a rally in the growth space. Okay, and this could easily rally back up to the 200-day average or even higher. Okay, and if reporting goes well, by sort of Feb, March, we could be back up near 1250, 13,000, something around there. Okay, I think that's easily done on the back of some good reporting. And I'll just measure out what type of move we'll be talking about there. To the 200-day average, you've got almost 10%, and then to the next resistance after that, you've got 17%. The next resistance after that, 25%. Right? I think any of that could be on the table if that scenario plays out. Scenario number 2, okay, the Fed comes out super hawkish, okay, starts really talking that interest rates are going to shoot up 50 or 75 points come Feb. I don't think that's going to be likely given the low European CPI we saw. We see a high CPI reading out of the US on Friday, bit higher than expectations. And then from there, that spiraling effect comes into the market where everyone starts stressing out about higher interest rates for longer. And then this breaks lower through that 10,000 level, okay, and in that case is, it could be heading much lower. Okay, so coming across that sort of weekly chart on this index, you can see that it has come below that 200-week average, which is not something that commonly happens. Okay, we haven't been below that 200-week average since back in the GFC times. All right, even COVID, it didn't quite get ducked below, but came back above. So the 200-week average, guys, we are now below that level. So for me, a break of this 10,000 is very significant. Okay, and then if that does break, it'll probably lead the S&P lower, which is still holding above the 200-week average. But if that breaks, it's very bearish signs. So they're the 2 scenarios in my mind, right? I don't think this is going to go sideways forever. Okay, we might have a short period of sideways here, obviously, and that's what we're seeing. But as soon as that pennant breaks, I think we're going to have a view that may play out for a few months, okay, and actually have a theme that we can come in and trade and have a good play around with. All right, so just to quickly summarize through, I think I've already spoken a lot about this, but you got Jerome Powell talking tonight. That's quite significant as markets are pretty much hooked to any data or any information around interest rates, right? Any hints that he's going to give in his speech, the market's going to whip around on. The last time he spoke, he kind of talked a little bit about a soft landing. That was positive for the market at the time. But, with markets fairly low at the moment, I don't think he's going to come out super hawkish. With the recent CPI's readings coming in a little bit lower, I think it's could be taking the pressure off these guys a touch. He's still going to have to talk strong. Okay, he's still going to be hawkish. Don't get me wrong. There will be hawkish talk. But what we're looking for is that sort of the way he talks to sort of calm down and really talk about the soft landing and what it could look like if things do play out to plan this year. And I think that's the path he's going to go down because at this stage, it's widely expected that inflation is going to come in lower. And it's widely expected that they're going to lift rates by only about 25 points come Feb. So I think that he might calm his farm a little bit here, right? And just talk a little bit softer, not dovish, but just a little bit softer than what he was talking throughout sort of November and earlier periods. CPI Friday, super critical, guys. They're expecting another substantial fall down in the CPI reading for the US. Yeah, look, if that comes in as expected or lower than expected, I think markets could rally pretty damn hard on the back of that. So yeah, look, CPI is key Friday morning. That'll come out about half an hour before the US market actually opens. All right, so then that kind of leaves the question of whether the Nasdaq has bottomed or not, and that's going to really be down to how the data flows. Okay, if we can see a clear sign of the Fed cooling down and not lifting rates as quickly, and even a potential drop in interest rates again, it's not that they're going to drop interest rates this year. I don't think they probably will. It'd be more that they start talking a bit more dovish, right? And talking to interest rates coming down next year. Because you got to remember, markets are very forward looking. You got to remember the Nasdaq is significantly lower to where it was at the highs early last year, and at some point, people are going to come in and buy. So I think at this point of time, and what I'm personally looking at the moment is how do I trade that? And I either in the Aussie market trade some of the tech plays and discretionary plays that have been beaten down, or I look for an ETF that is going to give me exposure straight to the Nasdaq, and there is leveraged ETFs out there in the US market and things like that as well. You've got geared ETFs to the S&P 500. There's a few things and ways we can play this, right? So it's about getting ready. Work out what instrument you're going to use to trade it, because at some point we will see some breaks to the upside. Now, the big difference for me here is I think it's going to be more of a W-shaped type recovery. So we're going to whip around. We're going to have a few false attempts to the upside and pullbacks. Okay. Whereas with COVID, you had that pretty much a massive V-shaped recovery. Okay. Here, I think this is going to take a while. So don't expect, the market to double itself like it did after COVID, right? In a 12-month period. It's not realistic. Be realistic, guys, okay, and look to trade it smartly. So what that means is back to a more traditional W-shaped type movements, upward channels, things like that. May take a few attempts to break higher for a move up to actually sustain as the market continues to flirt around with hard landings, soft landings. Have interest rates topped? Have they not? Company earnings, how things are moving, hard landing, all that sort of stuff is going to be running around investors' minds this year. But just keep in mind, these stocks have fallen a lot already. Okay, so if we can achieve a soft landing in the US, then we could be getting pretty close to the bottom here, guys, right? That's the reality. So looking for a combination of technicals, looking for a bit more confirmation around the Fed. Obviously, we're still very early in the year, so we could be talking very differently in a few weeks' time. Reporting season, super important. Okay, we want to see how the earnings have held up as the economic growth in the US has slowed. And I think the discretionary side of things may surprise you guys because people are still employed. They're still making money. There's still huge credit card debt happening over in the US. People are still spending money, right? Maybe not as much as they were coming out of COVID because we all got pretty excited. But nonetheless, I think that, perhaps earnings won't get hit as hard as some people are thinking. Not quite yet anyway. We might be waiting a little bit longer to see, how things play out in that regard. So look, I'm probably a little bit more optimistic between now and March. All right, I'm probably thinking a little bit more bullish. I actually think this reporting season for the US will be reasonable. I think the February reporting season for Australia will be reasonable, and I think that the US market has heavily sold down. There's a little bit of optimism around inflation coming down, and we're seeing that through the energy markets. We've seen a lot of things calm down, so that should translate to a few lower CPI readings, and I think that will translate to a little bit of a bullish rally into March. From there, it's going to really come down to data flow and how things are looking from that point. But I do feel we're going to have a bit of a rally up through the first quarter or even first half of the year. At some point, we'll get this another big whack down on some bad news, okay? Because the market will be squirmish with the whole monetary policy setting much higher than what it was, okay? Investors are a lot more squirmish when interest rates are higher. So another big bit of news could easily send us lower. But then I think we'll actually finish the year off with a bit of a high. Okay, I'll be very surprised if the US market doesn't finish off higher than where it has started down here. Okay, so really for me, getting back across to our charts, S&P, right, for me should find itself back up near. So get back to a daily chart. I'll be very surprised if we don't finish the year back near sort of at least 44. Okay. I think we'll have a few goes at getting up there, at least 44, 44.50, something around these types of levels here. There's a good equilibrium through here, guys, okay, through the middle part there. All right, well, you spent that time going sideways around 45. So around those sort of 44, 45 levels is where I'm predicting at this point in time, okay? All right, so that's where we're at, guys, okay? Might leave it there. Thanks for listening in this week. I'll catch you all next week. Take care and bye for now.